Now it's official, we are in a recession.
The very word can send shivers down the spine of investors and policymakers alike. They're the economic downturns that punctuate periods of prosperity, bringing pain to businesses and workers. Everyone is now talking about a recession as economic concerns are flaring up simultaneously all over the world. Consumer confidence in the US has plunged to its lowest since 2021, with future expectations at a 12-year low, mirroring pre-2008 levels. Credit card defaults have surged by 50% in a year, with lenders writing off $46 billion in bad loans, the worst since the Great Recession. FedEx, a bellwether of global trade, issued a dire warning of declining volumes, echoing late 2007 freight slowdowns, while retail giants like Walmart have seen their valuations slump as shoppers turn cautious. Simultaneously, the yield curve has inverted, an omen that has preceded every US recession for the past half-century. And manufacturing orders and housing activity have slowed under high interest rates. Meanwhile, speculative bubbles in assets like NFTs, meme stocks, and crypto have burst, revealing eerie similarities to past manias such as the dot-com crash and tulip mania. Globally, economic hardship is already feeling unrest, from mass protests over living costs in 90 countries to political instability and collapsing governments. Taken together, these fractured indicators across spending, debt, manufacturing, finance, and geopolitics paint a chillingly familiar picture of a system on the brink. But what exactly is a recession, and why do they happen? How do you know when you are in a recession? Then there's a peculiar subplot. The very definition of recession has become a tug of war. It used to be straightforward. A recession was commonly defined as 2 consecutive quarters of declining GDP. It was a handy rule of thumb, easy for the public to understand. But in recent years, that definition has been challenged, massaged, even politicized.
Not a recession?
That's not the technical definition.
In terms of the technical definition, it's not a recession.
That is not the actual definition.
Is wrong.
When is a recession not a recession? Apparently, when it's politically inconvenient. Take the United States in 2022. The economy shrank in the first quarter and then again in the second quarter. 2 quarters down, a clear signal by the old rule. By that yardstick, a recession had arrived.
Confusion spreads through the canyons of New York City's financial district. More than 16.5 million shares change hands in a single day of frenzied selling.
But the White House refused to use the R word. They pointed to the job market. Unemployment was low, employers were still hiring in droves. How can we be in recession, they argued, if we're creating 400,000 jobs a month? Treasury Secretary Janet Yellen went on TV to emphasize that this is not an economy that is in a recession.
Well, look, you don't have a recession when you have 500,000 jobs and the lowest unemployment rate in more than 50 years.
Citing these job gains and consumer spending, technically, she had a point. The official arbiters of US recessions, the National Bureau of Economic Research, look at a range of indicators beyond GDP, jobs, income, industrial production, etc. This laid bare a reality. What recession means isn't just economics, it's become politics. No leader wants the stigma of a recession on their watch. The word itself can become political football. We saw similar debates in other countries where governments found ways to spin or delay the acknowledgement of recession, hoping to avoid spooking the public or markets. But why is there so much confusion around the semantics of recession? Why does this matter? Because when leaders dance around words, it can erode public trust even further. In the 1970s, British Prime Minister Harold Macmillan infamously said, "The country never had it so good," at a time people felt quite the opposite. That hurt his credibility. Similarly, telling people this isn't a recession while their real incomes are shrinking and their grocery and energy bills are soaring is a recipe for resentment. Yet, the temptation for officials to avoid the recession label is strong, especially in today's hyper-partisan climate where admitting a recession is seen as admitting failure. The shifting definition of recession is itself a symptom of our times when information is abundant, but trust is scarce. Therefore, it is imperative we understand the common patterns across recessions. By learning to trace common patterns and unique triggers, we'll see what makes economies boom and then bust. It is essential we understand how different sectors like finance, real estate, tech, commodities, labor, and consumers all play a role. What are the specific indicators one should look out for to find out if there is a recession on the horizon? And in the end, we'll look how to spot the next recession before it hits, examining the warning indicators we need to watch, patterns across sectors, common threads in recessions. It's clear that while each downturn has its unique causes and contexts, there are several recurring themes across history.
Speculative exits and asset bubbles. Many recessions are caused by a period of overexuberance in one sector or another, whether it was the 1929 stock market bubble,
It was panic. 16.5 million shares of stock sold in a single
dot-com frenzy,
We're the mail site. People come to our site because they're into video games, DVDs, movies.
or the housing boom. A common thread is the prices of certain assets racing far ahead of intrinsic value, fueled by speculation and often easy credit. When those bubbles burst, they don't just hurt speculators, they often trigger broader financial distress. Bubbles tend to form whenever the hot new thing is. New technologies such as the railroads in the 1840s, radios in the 1920s, internet in the 1990s, crypto in the 2010s, or new markets like the housing finance innovations in the 2000s. The bursting of a major bubble delivers a shock to finance and to wealth, often pushing the economy into recession. Credit booms and banking crises. Almost every severe recession has a financial component. When people, businesses, or banks take on too much debt during the good times, the economy becomes fragile. In 1929, people bought stocks and margin.
There was another craze that captured America's attention in the 20s, playing the stock market.
In 2008, home buyers and banks binged on mortgage debt
Stop checking whether the income was even real.
because credit is the lifeblood of economy. If it stops, businesses can't operate.
A modern economy can't function without credit for more than even a couple of hours, frankly, seconds.
External shocks, commodities and geopolitics. Sometimes recessions start not because of an internal bubble, but due to an external shock. A prime example is the 1973 oil crisis, where a sudden jump in oil prices led to a severe global recession and stagflation.
Dallas area today, dealers raised prices to more than 40 cents a gallon.
Similarly, the COVID pandemic was an external biological shock. Wars or geopolitical events can also cause recessions. For instance, World War I's aftermath contributed to a 1920-1921 recession. The Gulf War oil shock hit the early 1990s.
On August 2nd, 1990, Saddam Hussein stuns the world when Iraq invades Kuwait in a surprise attack.
These shocks can hit specific sectors first. For example, commodities or supply chains, and then propagate. The key pattern is they increase costs or reduce availability of key inputs, which squeezes businesses and consumers, reducing overall demand. Policy tightening. Occasionally, recessions are brought on, intentionally or not, by governments or central banks trying to cool off an overheated economy. The clearest case is the early 1980s. Inflation was out of control in the late 70s, partly due to oil shocks and wage price spirals. So the US Federal Reserve under Paul Volcker jacked up interest rates to extremely high levels to break inflation. It succeeded, but not without causing back-to-back recessions in 1980 and 1981 and pushing unemployment over 10%. This was a conscious trade-off to restore price stability. Similarly, in China, in the late 2010s, efforts to rein in debt caused growth to slow. So a monetary or fiscal policy shift, usually toward tightening credit or reducing spending, can prick bubbles or choke off growth, leading to a downturn. Policymakers try to manage a soft landing, but history shows it's hard to perfectly calibrate. Often the result is a recession. Consumer and business confidence cycles. All recessions involve a collapse in confidence. People and firms suddenly switch from optimism to fear.
And bank after bank across the country is hit by panic withdrawals.
You'll notice an example. Once panic sets in, be it in markets or health or whatever, behavior changes rapidly. Businesses halt investments, freeze hiring, or lay off workers to conserve funds. Consumers tighten their belts, increasing savings and cutting non-essential spending. This shift in behavior can create a self-fulfilling contraction. During the Great Depression, the fear and pessimism were palpable.
And their business is destroyed, the closing was tragic. Yet when the bank was finally liquidated, in the worst years of the Depression, it paid back 92.5 cents on the dollar.
In 2008, there was a moment where it felt like the world is ending financially, and people really pulled back. Consumer behavior often amplifies downturns. In good times, consumers may overextend, taking on debt and assuming good times will last. And in bad times, they retrench hard. Likewise, labor markets reflect this. Companies swing from vigorous hiring to widespread layoffs very quickly around recessions.
In short, recessions usually involve some combination of overinvestment, debt buildup, external shock, and shifts in sentiment. They're often brewing under the surface even before the boom.
Predicting the next recession. Indicators to watch. Given these patterns, can we see a recession coming? This is a million-dollar question that economists and investors obsess over. The honest truth is that predicting recessions is tricky. Even the experts often get it wrong. Recessions have often surprised us, as happened in 2008 to many, or in 2020 with the pandemic. That said, there are some warning indicators that historically tend to flash red before a downturn. Smart analysts keep an eye on these to gauge when the economy might be overheating or when a slowdown looms. Here are a few key indicators and signs to watch for future recessions. The inverted yield curve. This has become one of the most talked about predictors. Normally, long-term interest rates, like on a 10-year government bond, are often higher than short-term rates on 2-month or 3-year bonds, reflecting growth and inflation expectations. But when short-term rates rise above long-term rates, it's called an inverted yield curve, and it signals that investors see trouble ahead. They expect future interest rates and inflation to be lower, often due to a recession. An inverted yield curve has preceded almost every US recession since the 1950s. For example, it inverted in 2006 to 2007 before the 2008 crash, and again in 2019 before the 2020 recession. It's not a perfectly timing tool. Sometimes the recession comes a year or more after the inversion, and there was one false alarm in the mid-1960s, but it's about as close to a reliable warning signal as we have. So if you see the yield curve invert, often reported in financial news,
the yield curve has been kind of an overhang.
Inverted yield curve, yikes.
Inverted yield curves.
That's a sign the risk of recession is elevated. It basically means credit markets are nervous. Rapid debt or asset bubbles. If you notice that household or corporate debt is growing much faster than incomes or asset prices, that's houses, stocks, etc., and they're surging far beyond historical norms, that's a potential warning. For instance, the ratio of house prices to rents or incomes can indicate a housing bubble if it's way above long-term averages. In the lead up to 2008, debt levels and housing prices hit record highs relative to fundamentals.
New York Fed just released its latest report on household debt, showing that household debt levels overall, including credit cards, student loans, and mortgages, are at the highest levels since 2008.
Similarly, before the dot-com bust, stock valuations like price-to-earning ratios were extreme. These imbalances often correct, and the correction can trigger a recession if they're big enough. So, pay attention to signs of unsustainable booms because they often precede busts. Tight labor markets and rising inflation pressures. Towards the end of an economic expansion, you get low unemployment, which is great, but it can signal the economy is running at full tilt. This can lead to wage increases and inflation. If central banks then raise rates to combat inflation, it can slow things into a recession. Watching inflation rates and central bank moves is key.
Rising unemployment claims. One very timely indicator is initial jobless claims, the number of people filing for unemployment benefits each week. This tends to start rising slightly before the overall unemployment rate begins to tick up. If you see a clear upward trend in jobless claims week after week, it means layoffs are increasing, often a sign that businesses are reacting to a slowdown. A jump in the unemployment rate from its low point can also signal the expansion is over.
Worsening consumer and business confidence. There are surveys that measure how optimistic consumers and business managers are, like the Conference Board Consumer Confidence Index or the PMI surveys from manufacturers. If these confidence indicators plunge, that often foreshadows reduced spending and investment. For example, before past recessions, consumers often reported pessimism about the future job market, and businesses might report lower new orders. If companies start saying they plan to cut back on hiring or capital expenditures, that's a bad sign. You might also see it anecdotally. Hiring freezes, an uptick in layoff announcements, and more cautious corporate earnings forecasts. When confidence turns, a recession can become self-fulfilling. So these sentiment gauges are worth monitoring. Recessions are an inherent part of the economic landscape. Painful, but historically inevitable from time to time. As we've seen, they can be triggered by manias turning to panic, be it tulips, tech stocks, or housing, by policy and price shocks, or by unforeseen disasters. And as the saying goes, history doesn't repeat, but it often rhymes. The next recession won't be identical to the last, but if you listen closely to the rhyme and reason of past downturns, you'll hear the echoes and recognize the tune. Stay informed, stay prepared, and remember, after every winter, spring eventually arrives.